Welcome to Moneyconvos, where we discuss personal finance and investment tips. We're committed to helping people create wealth and achieve financial freedom. Follow us on Twitter, Instagram, Clubhouse, and Facebook, and subscribe to our YouTube and podcast. Alright then, let's head into today's conversation.
Hello, my dear friends. If you know a fund manager or a portfolio manager, do them a favor. Give them a really big hug because trust me, they really need it. The first quarter of 2025 was a roller coaster for financial markets. And today we are giving you a quick, clear snapshot of what went down, why it happened, and what might be around the corner for the rest of the year. Ready? Let's dive in. On a global scale, the first quarter of 2025 started on a very strong note. After 2 years of impressive market gains, investors came into January full of optimism. But as we moved into February and March, things started shifting, and not in a good way. Several key events rattled confidence in the market. For instance, in the US, the stock market opened the year strong, but ended Q1 down by about 4%. The fall was mainly driven by heavy losses in the large cap tech stocks, companies that had previously led the gains in 2023 and 2024. And in terms of the large cap tech stocks, you are talking about the Magnificent Seven. You mean your Nvidias, your Apples, your Alphabets, your Metas, and the likes. A huge factor behind this pullback was the resurgence of the trade tensions, which has been making the news for the past couple of months. The US government announced new tariffs on imports from China, Europe, and other trading partners, sparking fears of a global trade war. And the big tech firms, the Magnificent Seven, who are heavily reliant on international supply chains and their global sales, took the hardest hit. Every single time a new tariff was announced or a retaliatory action was reported, markets reacted wildly. Meanwhile, European markets performed a little bit better, ending the first quarter around 6 to 7% in local currency terms. One major reason for their strength was fiscal stimulus. What do we mean? Governments across Europe, recognizing the risks of slower global trade from the trade tensions announced by the US, rolled out several spending packages to prop up economic growth in their countries. That fresh stimulus helped offset concerns about uncertainty around global trade and kept consumer and investor confidence strong in that market. Unlike the US, where political and trade news drove fear across the country, Europe benefited from proactive policies from the central banks, and that reassured the markets. When it came to commodities, gold surged by about 19% in Q1 alone, reaching record highs. And this jump wasn't random. It was directly tied to the rising uncertainty in the markets. Every new headline about tariffs or slowing economic data sent nervous investors rushing into safe haven assets like gold. And bonds also told an important part of the story. In times of uncertainty, investors traditionally move money into safer assets. And that's exactly what we saw. US Treasury bonds returned nearly 3% during the quarter, as yields dropped from about 4.5% to 4.2%. This move was helped along by the Federal Reserve's change in tone because, for the past 2 years, the Federal Reserve had been hiking rates. But now, looking at the risks surrounding the trade war and the tariffs and how that may affect the US consumer, the Fed paused on hiking rates and hinted that, look, we could even start cutting rates later in 2025 if the economic conditions don't get better. And that shift or that announcement made bonds even more attractive for investors and sent the prices higher. In Europe, government bonds also performed better or well, particularly in the UK. For this year, inflation in the UK has been moderate or has cooled, and the Bank of England also acted in unison to how the Federal Reserve acted, where they hit the pause button on hiking interest rates, and that also drove investors into the UK government bonds, which are called gilts. Closer to home, the Ghana Stock Exchange had a notably positive quarter. The Ghana Stock Exchange Composite Index, which tracks the performance of all the stocks listed on the exchange, rose about 5.2% in Q1. Several factors drove this. First, the banking stocks. The banks posted better than expected earnings, giving investors a reason to get back into the sector after a rough couple of years. If you are a follower of local news, you would vividly remember the banking sector cleanup, which happened between 2017 and 2019 and rocked the financial sector heavily. Also, you could say the broader economic environment also helped, along with some renewed confidence in the economy after the change of government. Inflation, although still a concern, has remained relatively contained compared to previous years, and you could say this boosted consumer spending. However, the Ghana cedi still depreciated against all three major currencies, that's the dollar, the pound, and the euro, and this continues to be a problem for the country. Yet still, compared to the roller coaster seen in places like the US, you could confidently say that the Ghana Stock Exchange or the Ghana equity market held up remarkably well. Looking ahead, it's very difficult to predict how the markets will end up because the uncertainty still exists. One thing we can say for sure is if the governments are able to come to concessions, if there's some relief given to these companies in terms of the removal of tariffs, then we may see the stock market rebound. But if these tariffs continue, if these trade wars continue, then you may see some more inflows into safe haven assets like commodities. However, whatever the case, the biggest takeaway is nothing is promised. Uncertainty will always be there, and with that comes volatility. The smart move for you is to always diversify your investment. If you have the opportunity, not just across asset classes, but across geographic locations. Also stay focused on your long-term goals and don't react emotionally to the daily noise. Thanks for tuning in today, and we'll be back after Q2 to see how things are shaping up. Remember to stay calm, stay smart, and stay the course. Bye-bye for now.
Thank you for taking the time to listen to our thoughts. I hope you learned a thing or two and start practicing. Don't forget to follow us on Twitter, Instagram, Clubhouse, and Facebook. And subscribe to our YouTube and podcast. Do tell a friend about Moneyconvos so we all become wealthy together. Talk to you soon. Bye.